And that's the beauty of SBA. As you dive into SBA, there's a lot of ways to do it, but it's taking a lot of time with PPP and everything. Their backlog for CDC, loans, you're looking at probably 6 to 7 weeks the time they get a full package submitted to get SBA approval on that piece. So it really depends, because each deal is different. Each bank, each lender has a different appetite. But there's a lot of creativity that can be done to get these deals to the finish line, which is great, right? And at the end of the day, SBA is here to help small businesses.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Bo Eckstein.
Hello and welcome to another episode of the Investor Financing Podcast. And on today's show, we're going to talk about when is a SBA 7A a better option than a 504. I go back and forth on this question all the time, and it really depends, okay? It depends on a lot of factors. One is it just hard assets that you're financing? Because that's what 504 is really good at financing, is the hard assets. Typically, those are going to be deals that are usually greater than 800, 900,000, anywhere up to 20 million plus. And the 504 is good for financing real estate, construction, real estate assets, and then hard assets as well. Where the 7A is really good is everything else in between, including real estate. The 7A is good for business acquisition, because on a 7A, it can finance blue sky or intangible versus the 504 can't. So to answer your question, it really depends on the deal itself, and there's lots of factors. For example, right now, I'm working on a transaction where we're taking an office building and converting to a hotel. The challenging part on the 504 is that it's hard to get a CDC or a nonprofit. They're the nonprofit that essentially works with SBA on the funding of the second, or the B piece of the loan. I guess you'd call it a second. And those CDCs are, they're not really interested in hotels at the moment, and most banks aren't either for ground up construction. Where I find the 7A is a more liberal loan, and we're able to get cool things done. For example, the 7A can work with CPACE in the capital stack, whereas the 504 can't. The 7A can have a pari passu conventional loan, meaning there's for example, the office building that's being converted to a hotel, we're looking at doing a $7.5 million combined loan, which would be a $2.5 million loan with the conventional piece, and then a $5 million SBA 7A loan. So that's $7.5 million in proceeds, because that's what the sponsor needs to get this project, all the construction done. So typically in the past, you'd be limited to $5 million, but there are banks that will participate and do a pari passu conventional loan. And that's just not for hotels. That could be for any type of projects. Assisted living, I've structured some for assisted living, self-storage, pretty much anything, right? So sometimes it's kind of up in the air whether the 504 on paper for borrowers seems to be a better fit, because you got a senior loan, and then you have 40, which might be senior loans 50%, and then there's 40 or 35% of the SBA piece, right? So you're getting 85 or 90% financing. And the SBA piece is a 25-year term fixed. And right now it's in the low threes. So the rates are really good, versus the 7A is usually a variable rate amortized over 25 years. So it's not as attractive. That might be in the fives. So there's differences. Usually the bigger type deals for construction and so forth, the 504 may be better fit. But for speed, the 7A is a faster deal because on a 504, you have to get the senior lender on board, the bank on board. The bank basically funds the construction and the interim financing. And then once there's certificate of occupancy, the CDC comes and acquires the second loan. And that's usually 30 to 90 days after certificate of occupancy. So you have to have the senior lender fund the construction. And sometimes they don't fund, they're okay funding their piece, their senior piece. And then there's also third-party companies that will fund the interim construction part before the CDC acquires that piece, right? So there's multiple ways these things can be done. And that's the beauty of SBA as you dive into SBA.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Are you in the market for a commercial loan? Did you find the perfect opportunity but need funding? Have a special situation? At Find the Bank, you will get quotes with competitive rates and terms from multiple lenders without any hassles. Have a multifamily property, construction project, owner-user property, industrial, mixed use, hotel? At Find the Bank, you can get nearly any kind of commercial financing. The process is simple. Once you send us some information about you and your property, we send back a quote sheet. Then we quickly connect you with an advisor. You won't spend hours calling multiple banks trying to find the right person to talk to. We'll connect you fast to the right person, hassle-free. Better terms than you could get on your own. Go to findthebank.com and complete the form. An advisor will be connected with you within minutes to discuss your specific financing needs.
There's a lot of ways to do it, but it's taking a lot of time with PPP and everything. Their backlog for CDC, loans. You're looking at probably 6 to 7 weeks the time they get a full package submitted to get SBA approval on that piece. So usually goes to the bank underwrites it, they give a LOI, and then you get the CDC engaged, or maybe vice versa. It just kind of depends on the deal. But kind of circling back, both are very good loans, and I think the deal kind of plays itself out. And as the deal is progressing, you figure out pretty quickly, does a 7A make more sense or a 504? And that's really the facts. And you can actually do a 504 with a companion 7A. Not all banks do that, but you can. We've structured some deals like that. So there's a lot of ways to do this. You can actually get 100% financing, meaning you get the SBA 504, and that 10% could be a partial seller carryback. It could be a rollover from your. So there's creative ways even to bring in your equity. You can get seller finance, and sometimes that seller finance needs to be on standby, meaning if there's not enough cash flow that seller piece they finance, they don't get payments for the first couple of years. It's called on standby. So there's lots of ways of structuring this. And when you're negotiating businesses to acquire a business, that's where you got to be creative. Because a lot of times when you're underwriting these deals, we have to look at the past 3 years of the seller's tax returns, right? And oftentimes they write off everything. So it becomes more challenging to underwrite these deals. So sometimes you have to get a bigger seller carryback. You got to be a little bit more creative on the way you structure these. But at the end of the day, on a business acquisition, if they're losing money on their tax returns, it's going to be very difficult to get SBA loan. So anyways, but SBA 7A will also work on projection based. They're more aggressive versus 504 really doesn't work that great on projection based deals. So 7A is a lot quicker. 7A is a lot more flexible, but long-term kind of real estate backed type transactions is usually good for a 504, but it still just depends. So give me a call. Happy to talk to you about SBA. We've got a large network of banking relationships and non-bank SBA lenders. There's non-bank SBA lenders. I work with a non-bank SBA partner, and they've said they're 504 lender, and they said that as long as we get CDC approval, that they will do the deal. So they're not overlaying. A lot of the banks overlay, and certain banks have appetites for certain different transactions. So it was really good to align with this non-bank SBA lender, because sometimes you can get a CDC on board to get the underwriting done first and then go full circle. So it really depends, because each deal is different. Each bank, each lender has a different appetite. But there's a lot of creativity that can be done to get these deals to the finish line, which is great, right? And at the end of the day, SBA is here to help small businesses, grow and thrive. And so it's fun as I dive more into the SBA world, learning and figuring out things, just the amazing tool it is. Anyway, thank you for watching the Investor Financing Podcast. I'm your host, Bo Eckstein, and I appreciate you, and I'll see you on the next episode.